Welcome to WebFit News. We're breaking down a major review of New Zealand's investor visa program and what it means for the economy. New Zealand has attracted over $2 billion in investor money in just 1 year. But the government is asking a critical question. Is that money actually helping the economy, or is it just sitting idle? This is all about the Active Investor Plus visa. It was recently redesigned with a clear objective. The idea was simple: bring wealthy global investors and their capital directly into New Zealand to stimulate growth. The main goals were to support businesses, create jobs, and inject capital into the productive parts of the economy. On paper, billions have certainly come in. But here is where things get uncomfortable. The core issue under review is that a large portion of this money is not being actively invested. Instead of funding new ventures, much of the capital is sitting in low-risk, passive assets, essentially just parked. In simple terms, the money is entering New Zealand but not moving. And when money does not move, it fails to create the real economic impact that the visa was designed for. Immigration Minister Erica Stanford has now officially raised concerns that the current system is not delivering on its promise. The government expected to see a significant uplift in business investment, innovation funding, and economic growth. Instead, they are seeing capital parked, limited risk-taking, and a lower overall real impact, leading to a full review of the rules. This review is bigger than just visas. It matters because New Zealand has a small economy that depends heavily on productive investment. The nation relies on business growth and job creation to thrive. If billions sit idle, the opportunity cost for the economy is massive. That money could have funded startups, supported struggling local businesses, and boosted national productivity, but instead, it is currently underutilized. So what could change? The government is now seriously considering tightening the rules for the Active Investor Plus visa. Possible changes include requiring significantly more active investments and heavily reducing the options for passive investment. The goal is simple: push investors toward higher impact sectors and essentially make the investment money work harder for New Zealand. These changes have a wider impact, balancing the needs of the economy against the incentives for global investors. For investors, tighter rules mean more risk and stricter conditions on how and where they deploy their capital in New Zealand. For New Zealand, this could mean more real economic activity, stronger business ecosystems, and better long-term growth. However, too many restrictions could scare investors away. The real question now is whether New Zealand will prioritize attracting easy capital or ensuring that the money translates into meaningful economic impact. The outcome of this review will define the country's economic direction.